talking to a home buyer about mortgage insurance. She got several different quotes from several different companies and she was confused. But you got to be really careful with mortgage insurance because it's very easy to overpay if you don't fully understand what's going on. So mortgage insurance is required when you don't put 20% down on a home. So if you were to buy a $100,000 home and you put $20,000 down, you would have no mortgage insurance and this wouldn't apply to you. But if you put down 5, 10, 15%, anything less than 20%, you would have mortgage insurance. The reason why you have to do this is you have to protect the lender in case you default on the home before you get to an 80% loan to value. So how do lenders address mortgage insurance? There's 4 or 5 different ways. The first thing they do is they just say, okay, this is your loan. This is the monthly mortgage insurance amount. Hypothetically, on a $100,000 loan, it's $75 a month. You pay the $75 a month until you get to 80% loan to value. In this scenario, if you refinance or you sell the house prior to when you get there, then you only pay mortgage insurance for the period of time that you were at that loan to value. The next way a lender might do this is they might say to you, hey, listen, you don't want to pay it monthly. Let me just increase your interest rate slightly. So all they do is they calculate how much the mortgage insurance would have been over the entire period of time, and they increase your interest rate in order to cover that amount. Now, one thing about this is you have to realize that if you refinance or sell the house earlier, then you might end up paying a little bit extra money because you've financed it in at the entire period of time. Another way where people find themselves losing money is the lender says to them, hey, you know what? We're not going to finance it into your rate. We're going to finance it into your loan amount. So if you buy this $100,000 house and you put 10% down, which is hypothetically you would have a loan of $90,000, now they make your loan $93,000. They've added the cost of the mortgage insurance premium to the actual loan amount, and they finance all of it into your loan. This is really, really a bad way to go because you've financed your mortgage insurance with the interest rate, and in addition to that, if you sell your house or refinance your house before you've fully captured all the value of the mortgage insurance, you have to pay back the full amount because it's financed into your loan. Another option, which is very similar to that and is also kind of a bad way to go about it, slightly better, is paying cash for the mortgage insurance. They say, hey, we're not going to finance that $3,000 into the loan. Just bring an extra $3,000 to settlement. That way, you will not have any mortgage insurance. Now, in this scenario, you won't pay interest on the $3,000, but if you refinance or sell your house before you've captured the full value, you just lose that money. Those are basically the different ways to do mortgage insurance. In this environment, I actually think it's better to just pay monthly for the mortgage insurance so that you have options to sell your house, refinance your house, and not